a couple different things. And I guess where I'm trying to go with this is we're tying the appraisal into the guarantee, because the bank, and this is not an SBA rule, but I think it's a pretty common bank rule. The bank will take a certain percentage, and they'll say, okay, we will consider whether or not to take additional collateral based on what the appraisal value is, the loan to appraisal. Now, for an example, let's just say that you're gonna borrow say $2 million. Okay. And the bank will have this appraisal done. And let's just say the whole property was like 1.7 with land and construction, and you're borrowing 300,000 in like lease up reserves and things like that. Okay. So you're going to borrow 2 million. The appraisal comes back lower than 2 million, right? They're not going to really give you credit for potentially the 300 grand of interest reserve that you want to borrow. You may borrow 18 months worth of interest reserves plus 100 grand for furniture and another 50 grand for whatever else, right? They may not give you that credit. And again, it's going to be up to the appraiser how they're going to value everything. But if it's short, then this is where that additional collateral may come into place, right? Because if the value of the future property, it's not even built yet, the future property, when the appraiser looks at the bid and the land and everything and says, okay, well, I think it's going to be worth this, the future value of it, the bank wants to be at a certain loan to appraisal value. Now, if that value is lower than their number, that's when they may come in and say, hey, I'll still do the deal. I'll still lend you that much money, the 2 million in this example, but it appraised at 1.7 and you want to borrow, 2 million. So I need an extra 300 grand of collateral. They may say, okay, well, what about real estate? And you may have to put a second on your real estate. If you don't have any real estate, or if you don't have enough, another sequence of events may be, they may require you to get an additional life insurance policy that they are a co-signer on to make up some of that difference. So it can be done. It does again allow a ton of leverage, the most leverage that I've seen, but there is, give and take on this. It's not free money. It's not without risk. So just some things to consider as you're going through this stuff. Now let's talk about fees. SBA will definitely have more fees than going to a local commercial lender. You go to a local commercial bank, you're going to have a 1% origination fee, usually appraisal fee, doc fee, title fee, those kind of stuff. But mostly it's 1% plus a couple grand for these things, plus appraisal, right? The SBA, they're going to do a much higher fee than that. So they have a percentage that you'll pay, and I believe it has a max of 138,000. Because I haven't said this yet, but the SBA 7A, the max loan amount, not the max deal amount, but the max loan amount is 5 million. And whatever percentage that is, that gets you to 138,000. That is what you're looking at paying. So you will clearly for sure have a higher than 1% origination fee, but they don't double dip. And what I mean by that is you don't pay the SBA guarantee fee and pay an origination fee to the bank. The SBA program does not allow banks to take fees if they're using the SBA program. So the actual fee that I'm talking about, this SBA guarantee fee, is not paid to the bank. The bank actually doesn't get an origination fee on this kind of deal, which may be why they're charging higher interest rates. But so they don't get an origination fee. There's the SBA guarantee fee, which goes actually into the SBA program. And again, this is where they're collecting and pooling money, so that if someone does default and they have to pay the bank back for their loss, this is where that money comes from.